In late 2024, Iran and Russia quietly flipped a financial switch that could change how sanctioned countries deal with the rest of the world. At a ceremony in Moscow, officials marked the linking of Shetab and Mir, their national card payment systems. It might sound like a dry banking news, but the move carries real geopolitical weight. For the first time, Iranian bank cards could be used in Russia, and Russian Mir cards could soon pay for goods in Iran. Behind this integration is a simple idea. If Western sanctions block the usual financial highways, build your own roads. What's happening here is more than a workaround. It's the gradual construction of an alternative financial network between two economies, long punished by the US and European restrictions. The first phase allowed the Iranian cards to withdraw rubles from Russian ATMs. The next step, already rolling out, lets Russian Mir card holders pay at Iranian stores equipped with near field communication terminals, contactless payment machines that allow tap-and-go transactions between a card or smartphone and a reader. The goal is full interoperability. Retail payments, withdrawals, and cross-border settlements without relying on SWIFT or global giants like Visa and MasterCard. 11 Russian banks already handle Iranian transactions, and Tehran says the network will be fully operational by the end of 2025. Together, Iran and Russia accounts for nearly $50 billion in annual bilateral trade potential, and officials expect cross-border tourism between the two to double once payment interoperability is complete. The Mir card network itself now serves over 150 million cards inside Russia, representing roughly one-third of all domestic transactions, while Iran's Shetab network connects more than 30 banks and 400,000 ATMs. Linking these two creates not just convenience, but a new economic artery between markets that were effectively disconnected from the Western financial bloodstream. What makes this important isn't just a technical success, it's what it says about the state of global sanctions. US and European restrictions are designed to choke off access to Western banking systems, assuming that isolation will cause enough pain to force behavior change. But in a world knit together by instant digital communication and involving payment technology, that assumption no longer holds. The more Washington cuts countries off, the more those countries learn to live and even thrive outside its reach. The Mir system itself was born from sanctions in 2014 after Russia's annexation of Crimea. Shetab and Iran evolved under decades of financial isolation. Linking them now turns those survival tools into a cooperative framework. Instead of being marginal players on the fringes of global economy, Iran and Russia are demonstrating that it is possible to build parallel systems. Slower, maybe, but functional and independent. Every sanctioned package, it seems, now accelerates innovation in non-Western financial technology. This integration comes as sanctions themselves reach record levels. By 2024, the United States and European Union had imposed over 18,000 individual financial sanctions worldwide, more than double the number a decade ago. Yet, global trade volumes continue to grow, and sanctioned economies like Russia's have maintained digital payment growth above 10% annually. Thanks to domestic alternatives like Mir, the lesson is stark. Financial isolation is not what it used to be. What potential does this Iran-Russia initiative hold for Pakistan? For now, perhaps more as a lesson than an invitation. The smarter move for Islamabad would be to watch closely and prepare quietly. Pakistan could start by developing its own domestic card and payment systems, similar to Russia's Mir or India's Rupee, to enhance financial sovereignty while staying connected to the global networks. It could also expand local currency trade settlements within the SEO or BRICS framework, reducing dollar dependence without crossing sanction lines. Low-key cooperation with Iran and Russia on fintech security and digital standards would let Pakistan learn from their experiences while avoiding direct exposure. In a future of fragmented finance, agility, not alignment, would define economic survival. There's a deep irony at work here. Sanctions once served as a precision tool of coercion. Now they're driving the very innovation that blunts their impact. The Shetab-Mir bridge isn't just a bilateral payment link. It's a symbol of how global finance is splittering into parallel systems. In a hyper-connected digital world, it is increasingly impossible to wall off major players. What was meant to be isolate is in fact integrating them in new ways. Sanctions are losing their bite, not because they have become softer, but because the world has become too wired to be contained.